Uh, what's up, everybody? This is Sungpo, the Korean bro. Today is 2022, December 12th. Let's look at stock market. Okay. Hmm. Uh, let's go to economic calendar. Hmm. First, what I'm about to do is look at the most important events from the states, which is FOMC meeting, interest rates news. Uh, we'll see when this happens. And as far as I know, on December 14, 2022, which is 2 days later, we'll have big event, FOMC press conference, Fed interest rate decision, FOMC statement, FOMC economic projections, crude oil inventories, uh, core CPI on December 13. On 15, we have initial jobless claims. So Wednesday is the most important day. It's the day that we have. It's the day when we have interest rate decision. So starting from that day, we'll have a big movement from the chart. Let's get back to malifu.com and see important news. Okay, three elite dividend stocks released 10% upside potential according to Wall Street. Down 30% this year is truest to buy before 2023. Down 52%, Amazon stock is a once in a decade buying opportunity before 2023. Three stocks to avoid this week, why tomorrow could be a huge day for a stock market. A bull market is coming. Three ways Warren Buffett is preparing. Okay. Let's read this one first. Down 30% this year is truest to buy before 2023. Since the merger, Truist has spent the last few years integrating the two banks. Investors seem restless and are looking for Truist to generate more operating leverage. But management still thinks it is on track to create a bank with industry-leading financial performance. Truist is the byproduct of the larger merger between SunTrust and BB&T. The super regional bank Truist Financial Group has wildly underperformed its peers this year, with stock down more than 30% compared to the SPDR S&P Regional Banking ETF, only down about 16.8% this year. Truist is the result of the large merger of equals between SunTrust and BB&T, which created a bank with more than $548 billion of assets. And author feels like Truist gets a lot less attention in the media than some of the other large banks out there, which could be due to complexity of analyzing new bank as it's gone through this big merger in recent years. Still, the bank continues to trade at a very high valuation. Is a stock buy before 2023? Let's take a look. Okay, Truist. It's obviously something that has to do with financial area, so I won't deal with it at this point. Down 52%, Amazon stock is a once in a decade buying opportunity before 2023. Let's look at a chart of Amazon. Okay. Okay. Macroeconomic headwinds have put additional cost pressure on Amazon, resulting in lackluster financial results over the past year. Amazon has a strong foothold in three growing industries, two of which come with much higher margin than its core retail business. Okay, so the business that they're about to do uh, will result in a much higher profit. So the business that they're currently doing uh, is not as big as the one that they're about to do. Mm. Okay, so Amazon currently trades at 1.8 times sales, a bargain compared to the 3-year average of a 3.7 times sales. Okay. Amazon has struggled this year, but patient investors have good reason to be bullish about the tech titan's future. NASA Composite has nosedived into a bear market this year, as investors have become increasingly pessimistic about high inflation and rising interest rates, both of which threaten to tip the U.S. economy into recession. But those concerns have hit Amazon even harder. Its share price has plunged 52%, marking its sharpest decline at any point in the past 10 years. Here's what investors should know about this once in a decade buying opportunity: the bear case for Amazon and the bull case for Amazon. And Amazon stock is trading at a bargain price. Let's get to bottom, okay? And given Amazon's strong presence in three large and growing markets, investors have good reason to believe sales will average double-digit growth for years to come. Better yet, Amazon should become more profitable over time, as AWS and advertising services are growing more quickly than its retail segment. With that in mind, the share is currently traded at 1.8 times sales, a discount to the 3-year average of a 3.7 times sales. It is a bargain price for a company poised to deliver double-digit sales growth over the long term. Also noteworthy, shares currently trade at 1.8 times earnings, roughly in line with the 3-year average. But that multiple should fall quickly as Amazon's high margin segments account for a bigger chunk of total revenue. That's why this growth stock is a screaming buy, and investors should jump on the opportunity before it passes. Okay, let's go to the bull case for Amazon and the business that they're about to do. Okay. Currently, they're focused on retail business, but the business that they're about to do is going to be much bigger. Okay, and let's concentrate on that and see what that is. Okay, the bull case for Amazon focuses on its strong position in three growing markets: e-commerce, cloud computing, and digital advertising. Retail may come with low margins, but Amazon will account for 40% of online sales in the US this year, giving it more than 5 times the market share of its closest rival, Walmart. So, uh, their competition, they're competing against Walmart, and Amazon account for 40% of online sales in the US this year. Okay. That means Amazon is still better positioned to capitalize on the secular shift to online shopping than its competition. And global e-commerce sales are expected to grow at 13% annually to reach $15 trillion by 2030. E-commerce sales are expected to grow at 13% annually to reach $15 trillion by 2030, according to Amico Research. So they have more room to go upward. Okay, better yet, Amazon is becoming a digital advertising juggernaut, due in large part to the popularity of its online marketplace. When US consumers are searching for a product, Amazon is the most common starting point, even more common than Alphabet's Google search, according to eMarket. That makes Amazon a valuable and partner for brands. In fact, the company is now the fourth largest advertiser on the planet, and Amazon nearly led the world in ad revenue growth last year. So here we have online sales, cloud computing, and what else do we have? Digital advertising. And mostly when people do online shopping, the first website that they go to is Amazon, and that means um, something, because as an e-marketer, they would certainly use Amazon as a source where um, people use it as a marketing source, right? So digital digital advertising. So advertising wise, they would use it. Mm. Cloud computing, digital advertising, and e-commerce. Okay, this has big implications. Digital advertising is a massive industry that is rapidly approaching $1 trillion, but it's also far more profitable than retail. Okay, it's far more profitable than retail. Okay. Hmm. Amazon has yet to provide specific operating metrics, but Google regularly achieves an operating margin over 30% in its ad business, so investors can reasonably assume Amazon is in the same ballpark. Additionally, Amazon Web Services is a clear leader in cloud computing, another quickly growing industry with high margins. In fact, AWS currently holds twice as much market share as the next closest cloud vendor, Microsoft Azure. So they hold twice as much market share as the next closest one. Mm. And regularly achieves an operating margin around 30%. That means AWS is poised to be a powerful growth engine in the coming years, as the cloud computing market is expected to increase at 20% annually to reach $1.7 trillion by 2029, according to Fortune Business Insights. Okay. So Amazon, its current price is 89.09, and once in 2018, its revenue was 232. 2018. Hmm. Let's repeat this one more time, okay? Mm. Given Amazon's strong presence, three large and growing markets, investors have good reason to believe sales will average double-digit growth for years to come. Better yet, Amazon should become more profitable over time as AWS and advertising services are growing more quickly than its retail segment. With that in mind, shares currently trade at 1.8 times sales. Hmm. Okay, I get it. And the next article we have is why tomorrow could be a huge day for the stock market. Okay, inflation has been running hot all year. The market is looking for more evidence that it is cooling. The new data could move stocks in a big way tomorrow. Okay. New inflation data is due out in the morning, and the Federal Reserve's final meeting of the year kicks off. The stock market this year has largely been in a state of uncertainty. That's because inflation has run rampant, and the economic outlook has gotten more and more negative to the point where most investors are now expecting some kind of recession next year or in 2024. After four consecutive jumbo 0.75 percentage point interest rate hikes, the Federal Reserve finally seems to be making some headway in its war with inflation. Although how persistent inflation might be is still a bit of a mystery. Mhm. Hold on, hold on, hold on, hold on. Anyway, okay. Anyway, okay. Tomorrow, the market will get more insight into how inflation is trending, which could also impact investors' broader view of the economy heading into 2023. It could be a huge day for stocks. Let me explain it. Okay. A mild or severe recession. At this point, I think the majority of market participants are expecting a recession at some point in the near future. The bigger question is whether or not there will be a mild or severe recession. The market could probably handle a mild recession. It may actually help bring down sky high consumer prices. Last month, the market reacted very positively when the consumer price index, which tracks the prices of a market basket of goods and services, only rose 0.4% in October from September and was only up 7.7% year over year. Inflation was still high, but the CPI came in much weaker than economists had been expecting. Still, it has been difficult this year to get two CPI reports in a row to show that inflation is easing. Other conflicting data has also muddied the waters. For instance, on Friday, new data from the Producer Price Index, which measures how much companies receive for items they sell and is a good indicator of wholesale inflation, rose more than expected on a monthly basis. Although it still seems to be trending downward year over year. Tomorrow, all eyes will once again be on the November CPI report, which will be released at 8:30 a.m. EST. Why the labor market is so important? There was also another somewhat conflicting data point at the beginning of this month. The November jobs report came in much stronger than expected, with the economy adding 263,000 jobs and the unemployment rate remaining unchanged at 3.7%. I found this particularly interesting because Fed Chairman Jerome Powell has previously said he needs to see some deterioration in the labor market for the fact to know that inflation is easing. So, the reason labor market is so important is because what Jerome Powell plans to do is to see deterioration in the labor market for the fact to know that inflation is easing. So he has to be certain with what he's doing. So if inflation is, then he's doing the right thing, right? While a strong labor market can be greater for the economy, it's actually been driving inflation this year because it's created a strong consumer who is spending heavily. But a likely best case scenario for the economy next year is that if inflation can cool while unemployment only rises modestly. Tomorrow, if the CPI once again shows evidence that inflation has peaked and is headed downward, that might make investors more optimistic about a mild recession and a soft landing for the economy. Of course, the labor market is often a lagging indicator. and I do not think we've felt the full effect of all the Fed's rate hikes yet. So let's get to bottom here. So how to think about tomorrow? Now casting a service sponsored by the Federal Reserve Bank of Cleveland, which makes projections regarding inflation, projects that the CPI in November rose by 4.47% from October, which will likely be perceived as disappointing because the CPI rose 0.4% on a monthly basis in October. Now, cash expects the CPI in November to be up by about 7.5% in year-over-year terms, which would be an improvement from October. Hmm. If CPI numbers come in under these projections, I would expect the market to perform well tomorrow because it will show the inflation is continuing to slow. Hmm. Keep in mind that if the numbers come in much lower, investors might get concerned that demand is drying up too quickly. And then, of course, if the numbers come in higher than expected, that might concern investors about persistent inflation and more rate hikes from the Fed, which will likely send stocks lower. So tomorrow we'll have big issues, right? Mm. Mm. Okay, let's read those carefully, okay? The global semiconductor market is expected to more than double to $1.38 trillion by 2029. Two highly profitable industry leaders are well off their highs and ripe for the picking. Meanwhile, one of the top performing chip makers since the end of the Great Recession is full of red flags. Hmm. The first maker that's a surefire buy in 2023 is industry stalwart and Dow Jones Industrial Average company Intel. As with most semiconductor companies, the inflation and supply chain issues have taken their toll on Intel in 2022. But in addition to these concerns, Intel's share price has been weighed down by chief competitor Advanced Micro Devices, chipping away at its share of central processing units sold in personal computers, mobile devices, and data center servers. While these are all tangible headwinds, none of them are particularly concerning or a long term or a risk of derailing Intel's turnaround strategy. Let's start by addressing the elephant in the room. Yes, AMD is taking a market share from Intel and has been doing so for the past 3 years. While it would be ideal for Intel not to lose share to AMD, the important thing to note is that the percentage of share loss remains relatively small. Mm, Broadcom. We have Broadcom and Intel in our list. Don't overlook autonomous vehicle company Mobileye Global, which Intel acquired for $15.3 billion. Mobileye debuted via initial public offering in late October and now carries a $25.5 billion market dollars cap. More importantly, Intel remains the majority shareholder of a company that grew sales by 38% in a challenging third quarter. Okay, let's look at charts of Intel. Hmm. Okay, let's get charts of a Broadcom. What is it about Broadcom? The chief concern among Broadcom skeptics appears to be the growing likelihood that recession will reduce chip demand for Broadcom and perhaps shrink its backlog. So this author is worried about sales of chip, right? Even if this outcome were to materialize, it would be short-term speed bump for a company with a mountain of catalysts. Hmm. The biggest driver for Broadcom is the 5G revolution. For much of the past decade, wireless download speeds weren't meaningfully improved. But with telecom companies steadily upgrading their wireless infrastructure, 5G speeds are now a reality. This means the ongoing device upgrade cycle for consumers and business should take place through mid-decade. Broadcom generates most of its revenue from selling wireless chips and accessories used in next-generation smartphones. So, okay, now I get it. Broadcom sells wireless chips and accessories for next generation smartphones. Hmm. It's their main revenue. Okay. Something else to add to the above is that owning a smartphone and having wireless access have evolved into a basic necessities. Not even a recession will likely to cause a significant uptick in wireless service cancellations. So not even a recession can interrupt their business because every smartphone gotta have wireless chip in it, right? So uh, okay, why would he think that people have to avoid Nvidia in 2023? But not every semiconductor stock can be a winner. Although it's been one of the top chip makers to have in your portfolio for well over a decade, Nvidia can be comfortably left on the shelf in 2023. To be perfectly clear, I'm in no way saying Nvidia is a stock forever avoided. These are certainly catalysts that merited Nvidia greater than 8,000% return since the greatest recession bottom in March 2009. In particular, Nvidia accounts for close to 20% of the global graphics processing unit market and approximately 80% of discrete graphics cards, which are GPUs operating separately from the processor. GPUs account for the lion's share of NVIDIA's profits. Okay. Hmm. Okay. Four growth styles have been gradually bought before the next bull market begins. Hmm. And what do we have on our list? PayPal Holdings first. The three major US stock indexes have plunged by as much as 22 to 38% from their highs. Every previous bear market was eventually wiped away by a bull market rally. The current bear market downturn is the ideal time to pile into fast-paced companies with clearly defined operating advantages. First, we have PayPal Holdings. The first growth stock I've piled into well ahead of the emergence of the next bull market is fintech giant PayPal Holdings. Okay. Despite higher inflation clamping down on the discretionary spending of lower earning workers, PayPal's digital payments platform has demonstrated incredible resilience. What really stood out is that total payment volume across all of PayPal's digital payment channels has continued to grow by a low double digit percentage. After excluding currency movements, if TPV can sustain a 10% or higher growth rate, with US gross domestic product going backwards in each of the first two quarters of 2022, imagine how quickly it will be growing when Federal Reserve monetary policy becomes dovish. Mm, What's more, the company's marginally growing base of active accounts is becoming more engaged. When 2020 came to a close, the average active PayPal account completed 40 transactions over a trailing 12 months. Okay, let's see. PayPal Holdings. A completely off-the-radar growth stock I bought regularly during the 2022 bear market is a dog-focused pet product and service provider Bach. Okay. Wait, I'm gonna have to finish this YouTube live because I got an important call to make. So I'll be right back. Okay. Bye bye.